Let's have a look at a case study where you will have to reduce the cash gap. So imagine that you have bought a firm providing data science services. You will mainly use a debt put on the purchased firm, but there is still cash gap you have to take care of. A few information about the firm that we'll be analyzing. So first of all, they have 500 data scientists and 80% of the time are billable hours. Customers pay on average 48,000 euro per year per data scientist, and we're going to consider 8 scenarios. So in the first one, which we call small reduction of receivables, we assume that the receivables conversion period, so in other words, days sales outstanding, will go down from 90 to 60 days starting from year 2. And we assume that such a small decrease will not impact sales growth. Then in the second scenario, we assume a bigger reduction of receivables conversion period. So not from 90 to 60, but actually from 90 to 30. And this will unfortunately impact the growth. The growth will go down from 20 to 15%. In scenario 3, we use factoring. And we assume that due to the fact that we're going to use factoring, the receivables conversion period will go down on average from 90 to 10 days. The annual rate that the bank's going to charge us for the factoring service is 5%. In scenario number 4, we take in year 1 additional credit line to cover the fact that we have to have cash for all the expenses to grow. And this line we're going to keep using through the whole forecast period. In scenario 5, we'll be playing with the payables. So we're going to increase payables conversion period from 10 to 13 days starting from year 2. In scenario 6, there will be a bigger increase of payables. So we're going to go up from 10 to 60. But we will have to pay more our employee for that. So we're gonna have a margin lower. It will go down from 20% to 19%. In scenario 7, we assume that we will play a little bit with the price. So we're gonna increase it from 48k to 50k. And this will cause the margin to go up from 20% to 24%. And finally, scenario 8, we're gonna have a big increase of price. So from 48 to 52. The revenue will grow at a much smaller rate. So instead of 20% annual growth, we're going to experience 5% growth. However, obviously the margin will go up from 20% to 28%. So that's in short when it comes to the scenarios. Let's go to the next lecture where I will show you the data set that you should use to solve this case study. We're going to start with the first 4 scenarios where we will be mainly playing with the receivables. And later on, we're gonna discuss the next 4 scenarios. Let's have a look at the available data that you will need to solve the case study. Please open a file attached to the lecture, which is called Reduce Cash Gap Consulting Firm Empty. And here in the master sheet, you'll find a table of content. As you will see, we have prepared for each and every scenario a separate sheet where you can play with the assumptions. All the sheets, they look exactly in the same way. They will look exactly as the current situation sheet. So we're going to just discuss this one in this lecture. And obviously later on, we can compare all the scenarios in the comparison sheet. So let me explain how the current sheet is built. This will be exactly the same way in which each and every sheet is built. So we first start by estimating the revenues. We do it for 5 years. So this is first year where we do this transaction. In column K, we've got second year, then third year, fourth year, and fifth year. Revenue we estimate by looking at the number of people we've got. And as you can see, we have assumed in the current scenario 20% growth every year. And then we've got the fee per one person, which is assumed to be 48,000. And this assumption is done in the sheet parameter. As we said, utilization is 80%. This is how we get to the almost 20 million in the first year, 23 in the second year, and so on and so forth. Then we estimate on the basis of that EBIT, and EBIT we estimate using revenue, and we multiply it by assumed percentage EBIT, which is 20%. So the first year we get almost 4 million, and then it grows as our revenue grows. Using the EBIT, we can estimate the profit before income tax, and this is simply the difference between EBIT and the interest paid and other financial costs, which we estimate a little bit below. On the basis of that, we obviously can estimate also the net profit. So this is just profit before income tax minus the corporate tax rate, which is 19%. And in this way, we get to the net profit. Now, since we want to have a look at the cash impact, we also look at other things like receivables and payables. So first, we estimate the receivables. We have them expressed in days of sales. So we assume that we are waiting on average 90 days to get our money back. This means that with the almost 20 million of revenues, we're going to have in the first year 5 million in receivables, and then it goes to almost 10 in year number 5. In the very same way we did the payables, so we have assumed certain amount of payables expressed in the days of sales, and we said it's 10. So again, they are growing as the revenues are growing, but they are not as that big as the revenues. Since we bought the company, we took some debt for that, so we need how much actually company was worth, so how much we paid for that. And we do that by looking at the EBIT in the first year and then assuming certain multiplier of 6. So in other words, we paid 23 million for the company. As we said, we took a debt for that. So in row 38, you've got the calculation of the annual installment, so the repayment of the debt. So it's 4.6 million, since we assumed 5 years that it will take us to pay. Obviously, if we change this, the whole thing will also change. Because we want to calculate the cash flow, we also have to estimate how the debt will change. So we have in row 43, the debt for purchasing the firm estimated at the end of the year. So the first year we take the debt, so nothing happens. And then every year, starting from year number 2, we repay the debt, and this is 4.6. So at the end of the second year, it will go down to 18.4 million. And then as we get closer to year number 5, it will be just 4.6 million. One of the scenarios will require additional credit line, so we provided a special place for that, and also a place where you can estimate the factoring costs. Now, we also have the total debt at the end of the year. This is useful because we can have more than one debt, and one of the scenarios actually that we have an additional credit line. So we have the previously calculated end of year value of the debt that we used to purchase the company, and obviously the additional credit line. Since we have to estimate the net profit, and you have seen we have used that as well, we have to calculate the interest paid on debt. And this is simply the multiplication of two things. So interest rate multiplied by the average debt size in the year. And this is simply the average of the beginning and the end. Thanks to that, we are able to calculate the operational cash flow. So in row 64, you've got that. So we start with the net profit. Then we add back depreciation, which is assumed to be 0. We remove the interest paid because we assume this to be a part of the financial cash flow. And we've got the change in receivable and change in payables. So for example, in year 2, as you can see, we'll be getting less money than it is suggested by the net profit, as we have receivables increasing by almost 1 million. In row 71, we estimate the financial cash flow. So here we look at the payment for the firm, which we finance by taking the loan. So one is with the minus, the other one is with the plus. You have an increase coming from the additional credit line if you take it, the repayment of the loan, and then you've got the interest paid, which we removed from the operational cash flow and we put it back with minus in the financial cash flow. So in other words, when it comes to financial activities in the first year, we're going to spend almost 2 million, then 6.2 million, and so on and so forth. This is mainly due to the fact that in the current scenario, we have to pay the interest and also the loan. So this helps us estimate the total cash flow. And this would suggest that first year we have generated positive cash flow of 1.6 million. But in the next years, we actually have a negative cash flow. So this would mean that we have to pay in some money as the owners of this company. And this is what we estimate in row 82. So in row 82, we have estimated that the first year will be fine, but in the next year we have to pay in 1.2 million, then 3.4, 4.6, 4.7, and so on and so forth. So in total, we will have to provide almost 5 million. And then finally, what we did, we estimated the company valuation. It's going up since the revenue are going up from 23 to 47 million. And what we also did, we estimated what is the additional value created for shareholders. So it's going up from 0, assuming that we have bought for what it is worth, to 38 million. And we calculated by looking first of all at the company valuation, which is going up as the revenue and the EBIT is going up. We also look at the cumulative additional cash that we had to pay in, and obviously the debt that the company still has. So in other words, in the current situation, if we don't do anything, but we still have to provide a cash equal to almost 5 million, we'll be able to gain from this transaction almost 40 million. Now, use the scenarios that we have defined, and in each and every sheet, try to implement them, and then look at the comparison to see which option is better. And obviously also define what better means. Are we talking about the company valuation or the cash that we have to pay in? Once we are done with the scenarios, move on to the next lecture where we'll have a look at the solution to this case study. I hope you managed to solve the case study on your own, but just in case, we're gonna go through each and every scenario in separate lectures. So please open a file attached to the lecture, which is called Reduce Cash Gap Consulting Firm Partial. And here you will find, as always in the table of contents, all the sheets. Just as a reminder, we started by looking at the current sheet where we went through revenues, EBIT, and then on the basis of that, we estimated receivables, payables, as well as the debt we need to pay the company for. And we use all the data to, first of all, try to estimate the operational cash flow, financial cash flow. And this information helped us determine how much money we have to pay in the company. So we have in row 86 that if we don't change anything, we'll have to pay in roughly 5 million in 5 years. And at the end of the year number 5, we will be able to generate around 38 million of additional value. And obviously we want to decrease the cash we have to pay in and increase the value we create for shareholders. So let's see how each and every scenario works. In this lecture, we're going to go through the first scenario. So we have a small reduction of receivables. This will obviously not impact revenue, EBIT, or net profit. So the change we're going to notice in receivables. And as we said in this scenario, we reduce the payment terms in such a way that receivables expressed in days of sales go down from 90 to 60. This obviously means that the receivables go down. So just as a comparison, let's have a look how it looks like today. So we've got receivables in row 25. And as you can see, it's almost 6 million in year number 2. Now, if we go down with the terms of payment, it will be almost 4. So we save around 2 millions. And for each and every year, we have this difference. Now, what does it mean for us? Well, it means obviously that our operational cash flow will improve. And here we've got the picture after we reduce the receivables. And let's compare it with today. So today, for example, in year 2, we are assumed to be able to generate 3.1 million of operational cash flow. And if we reduce the receivables, it will be almost 5 million. The difference in receivables was actually transferred here. This also means that we'll need less money. So in the case of current situation, we were supposed to pay in 4.7 million. Once we reduce the receivables, it will be just 2 million. And obviously also the additional value has increased. So we're going to be generating additional 41 million instead of 38 million. So as you can see, by renegotiating our receivables, providing that it will not impact the revenue, so the top line, and this was the assumption in the scenario, we are able to save in terms of cash roughly 2-3 million. And this will also increase the additional value we create for shareholders from 38 million to 41 million. Let's move to the next scenario where we will be drastically reducing the receivables. And this time around, it will have an impact. Now let's have a look how the picture would look like if we drastically reduce the payment terms. So instead of 90 days, we would have 30. So go to the sheet B receivables. And here we've got this scenario. So first of all, as you will notice, we went down with the payment terms from 90 to 30. Previously, in the scenario 1, where we had just small reduction in receivables, we went down from 90 to 60. And obviously the original one was 90. Now, currently, if we don't change anything, we would have receivables on level of 6 million. With the scenario 1, where there will be just a small reduction, it will be 4 million. And with the second scenario, where we do a drastic reduction, it's 2 million. So our receivables are smaller by 4 million. And this is to some extent due to the fact that we have a better payment terms. However, bear in mind that we also have a lower growth rate. So instead of 20%, we have 15%. So if we compare it with the current one, in the second year, instead of having 23 million in terms of revenue, we just have 22. Now, if we do a big reduction in the terms of payment in the second year, we would have EBIT equal to 4.4 in comparison with 4.6 if we don't do anything at all. Now, as we said, this will have obviously impact on the cash flow. So let's have a look at the cash flow. So the cash flow, if we do a big reduction in the second year, will be almost 7 million from the operational activities. With the current situation, so if we don't change anything, it is 3 million. So obviously the reduction in receivables caused operational cash flow to go up by almost 4 million. This obviously means that we will have to pay in less capital. So when we are looking at how much money we have to provide, it's almost nothing. So 76,000. So it's just 73,000. And if we compare it with almost 5 million in the current situation, there's a big change. And company valuation will also change. So when it comes to additional value created for shareholders, we said that currently we are generating 38 million. And if we do a big reduction of receivables, you will see that actually the additional value will go down to 35 million. So in terms of cash, we managed to achieve this goal. So we are putting less money. However, due to the fact that we experience lower growth, we will have a lower valuation. And therefore, we will also have a lower additional value created for shareholders. So in other words, if we do drastic reduction in payment terms, we will have to put less money into the company. However, at the very end, we'll be able to generate less additional value for shareholders. Now, let's go to the next scenario where we'll be looking at factoring. Now we'll have a look at the option, the scenario 3, where we, instead of asking our customer to pay us faster, we actually use factoring. So we get the invoices from him, we go to the bank and we get our money faster, but obviously for that we have to pay. So what will happen here is that the revenue will not change in comparison with the current scenario. The EBIT will also stay the same. What will change is the receivables. And here we assume that it will go down from 90 to 10. So instead of having almost 6 million as we had in the current situation in year 2, we will just have 640,000 in terms of receivables. Obviously, this comes at a price. So we will have to have additional costs on a factoring. And this is what we calculate in row 49. So as you can see, since we'll get 80 days reduction from 90 to 10, this means that we'll be financed for 80 days. And the cost of the factoring is 5%. This means that in year number 2, we'll have to pay additional cost of 256,000. Then it grows to 307,000 in year number 3 and up to almost 500,000 in year number 5. Obviously, additional cost when it comes to factoring means that also our net profit will change. So let's have a look at the profit with the factorings. So the net profit is 2.1 million. And now when it comes to the current situation in year number 2, it's 2.4. So the costs of factoring have decreased our net profit. Number 5, if we don't do anything, we'll have a 6 million. And with the factoring, we will have 5.6 million. So in other words, if we did the valuation of the company using a multiplier of net profit, the value of the company will go down. But we do it with EBIT. So since EBIT is not impacted, so it is the same today and with the option where we do the factoring. So we have almost 8 million in both scenarios. Then this will not have an impact on the valuation. Let's check the cash flow from the operational activities. Now, currently, as you can see in year number 2, we would be generating 3.1 million in terms of operational cash flow. With the factoring, this goes up to 8.1 million. And in year number 5, we will have 6.2 million instead of 5 million. This means that we will actually not have to pay in additional cash because we will have a positive cash position in each and every year. In other words, we'll not have to, as I said, pay in the cash to support the company. So as you can see with the factoring, we have 0 here, but in the current situation, we would have to pay in almost 5 million. So in other words, thanks to the factoring, we'll not have to pay in additional 5 million of cash. So the only thing we have to check is whether the additional value created for shareholders is bigger with the current situation or with the factoring. So let's have a look at the additional value created for shareholders at the year number 5. So it's 38 million, as you can see. And now with the factoring, it's 43 million. In other words, thanks to factoring, we not only reduce the amount of cash we have to pay in, but we also increase the additional value created for shareholders. Obviously, if we use the valuation method where we multiply certain multiplier by the EBIT, which we, as you can see, assume that will not change. Let's see what would be the effect of us taking a credit line. So let's have a look at the scenario number 4. Let's have a look at the scenario number 4. So we assume here that instead of using the things we have discussed so far, we simply get additional credit line that lasts for the 5 years. So what changes is actually in the special field we have created in row 47, we put 1.5 million, and this causes the total debt at the end of the year to go up for every year. So in the current scenario, we would just have this debt for buying the company. So we would have 23 million of debt for buying the company. And since we add additional debt, the total debt at year number 1 increases to 24.5 million. And obviously for every year, it is bigger by 1.5 million. This obviously means that the interest paid on the debt will go up, and obviously the net profit will go down. So let's have a look at the net profit that we'll have in the scenario number 4 with the credit line and compare it with the current one. So in the current situation, for example, in year number 1, we would have 1.6 million of net profit, and with the credit line, it's 1.5. For year number 5, we would have 5.9, and without the credit line, it's almost 6 million. So as you can see, you're losing some part of your profit due to the fact that you have to pay additional interest rate on the additional credit line. Obviously, the revenue will stay the same and EBIT will stay the same. So the valuation expressed as a multiplication of EBIT will not change as well. Let's have a look at the cash flows and compare them with the current situation. So in row 64, we have the operational cash flow. And as you will see, it will be slightly impacted in comparison with the current situation, as the net profit will be smaller. So instead of having 3.4 million in year number 1, we will have 3.4, and in year number 5 will be 5 million, whereas with the credit line it's 5.1 million. This is mainly due to the fact that interest paid we remove from the operational cash flow. Now the biggest difference will be in the financial cash flow. So if we compare it with the current situation, you will see that in year number 1, we would have a 1.8 million outflow of cash. And with the credit line option, it's just something below 500,000. So thanks to the fact that we have additional credit line, we don't have such a big outflow of cash in the first year. All in all, we will have to pay less money. So as you will see in row 86, we have to put 3.7 million into the company to support its growth, whereas with the current situation, it was almost 5 million. Now, when it comes to additional value created for shareholders, there is not much difference. So instead of having 38 millions, we had 37.9 million. So we slightly decreased the additional value created for shareholders and we saved some cash, but it's not like really a big difference when we compare it with the current situation. Let's compare the 4 scenarios we have discussed so far. So let's go to the sheet comparison, and you will see here that we used different ways to compare them. So we compare, for example, the revenues, EBIT, receivables, payables, how much money we have to pay in to the company in order to help it grow with the assumed growth rate. And obviously we have the additional value created for shareholders. Obviously we compare those things for each and every year. And here you've got the scenarios. So we have current situation, small reduction of receivables, big reduction of receivables, additional credit line, and obviously factoring. So what you will notice that the revenue, they are roughly the same for each and every scenario, only for big reduction of receivables where we assume a smaller growth rate. So from 20, we go down to 50, we have a smaller revenues. This will be the same also for the EBIT. So since we have a smaller revenue, we'll have a smaller also EBIT for big reduction of the receivables. The receivables obviously will have different value for different scenario. So for example, for year 2, we can see that currently we would have 5.7 million. Now, if we ask our customers just to slightly reduce the receivables, it goes down to almost 4 million. With big reduction, it goes down to 2 million. Credit line obviously does not impact the receivables. And in terms of factoring, it goes down to 640,000 in obviously year 2. Payables don't change, and what will change obviously is the amount of money. So let's have a look at the sum in column O. So you can see that in the current situation, we have to pay in 4.7 million. Then with the small reduction of the receivables, it's roughly 2 millions. With the big reduction, it's almost nothing. Then credit line, it's almost 4 million. And with the factoring, we don't have to pay in additional money. And finally, we have the additional value created for shareholders. So we can have a 38 million if we go for the current solution, then 41 million if we do small reduction of receivables. In the case of the big reduction of receivables, the value actually goes down to 35 million. Credit line is also a little bit smaller with 38 million. And the biggest is actually for factoring, so 43 million. Out of that, most likely we would say that the factoring is the best solution, as it means that we will not have to pay in additional cash. And actually the value we created for shareholders is the biggest, so it's bigger by almost 5 million. So as you can see, thanks to the way we approach the reducing cash, we were able to increase the value of the company by roughly 5 million, and we don't have to spend the 5 million in additional cash. So have a look at that and see what are the differences between each and every scenario. This will help you to structure such deals. And this is the way in which you should approach such cases. In the next section, we're going to discuss the 4 next scenarios where we will be playing with the payables and also the growth rates.